In today's video, I'll be discussing why middle-class Americans could soon be paying 45% effective tax rates. Hey folks, I'm David McKnight, best-selling author of The Power of Zero. In today's video, I'm interviewed by elite Power of Zero advisor and certified financial planner, Mark Bialik from Attleboro Wealth Management, where we discussed why middle-class Americans could soon be paying 45% effective tax rates. We also discussed whether the Trump tax cuts will be extended for the middle class, what the experts are saying about the future of tax rates, and how to adopt a balanced, comprehensive approach to tax-free retirement. So sit back, relax, and enjoy part one of my interview with elite Power of Zero advisor, Mark Bialik.
And let's start really simply and say, and I just want to ask you, it's been a little over a year since we did this last time. So the first question is, what's different today? What should we be paying attention to today?
Yeah, so last year this time we had 4 years until tax rates were going to go up. We know that the Trump tax cuts are slated to expire December 31st, 2025. So we had 4 years during which to take advantage of historically low tax rates, which means that here we are a year later, which means we have 3 years during which to take advantage of historically low tax rates. And you know, you and I have talked about whether those Trump tax cuts are going to get extended for the middle class or not. My thought is that they are, but there's no guarantees in life. So if you're looking to take advantage of historically low tax rates, you now only have a 3-year period within which to do so. Remember, every year that goes by where you fail to take advantage of historically low tax rates is potentially a year beyond 2026 when you could be forced to pay tax rates that are higher than they are today. And that means, the real life implications of that are that your money's going to run out faster. Okay, so anything you can do, there's lots of different things that you can do to help make your money last longer, and they all have a cumulatively meaningful impact. But one of those things is paying taxes while they're historically low. And if you fail to pay taxes, whether it's through a Roth conversion or making after-tax contributions to a Roth IRA or Roth 401k, every year that goes by where you fail to do that means that you've missed a window of opportunity. And so I'm all about getting the message out on why it's important to take advantage of tax rates while they're low, particularly because Mark, you and I have talked about how tax rates in the future have to rise dramatically to keep our country solvent. So I would say that's the big difference. The window of opportunity has narrowed.
Yeah. And, one of my favorite parts of your class is when we do what's referred to as the final exam. And I really connect with the Wile E. Coyote story. And I always talk, and it truly is one of my, you talk about it in the book, and it's even in the movie, I think, right?
Yes, I believe so.
Yeah. So, but it is one of my favorite episodes because it's one of the few times that the coyote talks, right? He's usually silent, and he refers to himself as Wile E. Coyote super genius. But it's so when I was teaching a course at Villanova, I like every time we're talking about this Roadrunner Wile E. Coyote situation and that pulling down of the window shade, right? And so many people are still doing that. And I've had to set aside my frustration and because, there's a few people that we can help one-on-one, right? There's only so many people we can help directly. Hundreds of people attend these classes and you hope that they're awakened a little bit and do something. But the masses are just going to find themselves on that railroad tracks. And unfortunately, they're not paying attention, or they just pull the window shade down and they say, it's not going to happen to me. I wish there was something that we could do I guess YouTube videos and things like that help. But, we were talking about how everything that we say, it gets reinforced all the time. And I was talking to one of the students from the class, and he said, I talked to my financial advisor and his CPA, and he said, they don't think taxes are going to go up. And my question always is, or my response always is when someone says to me, especially another professional, is that I could probably give you about a dozen reasons why taxes have to increase substantially, if not double, over the next, now we're within 10 years, right? Just give me one real reason why they won't have. Not, I don't know, there'll be some kind of catalyst, nothing that, something meaningful, that just one reason. And nobody has ever been able to give me a good reason. So let's talk a little bit about some of the reports that came out over the past couple weeks. That the Congressional Budget Office and the U.S. Treasury had some really important things to say, and they're saying it again and again and again. And I hope that people start paying attention. But do you want to take that and talk about some of the things that came out from the government reports?
Yeah, so there's really two things that really stuck out in my mind. And that's that, well, this year there was $1.4 trillion, $1.4 trillion deficit, which means we had to borrow $1.4 trillion just to be able to pay our bills, which basically means we added $1.4 trillion to the national debt. One thing that was interesting, and I've long predicted that this was going to happen, is it says that we will average $2 trillion per year of debt starting in 2023, going through 2033. So what does that tell you? That tells you that if we're at about $31 trillion of debt right now, we're going to be by 2033 add another $20 trillion to that. So we're going to be at $53 trillion. When you're at $53 trillion, you're fast approaching the moment in time when all of the revenue flowing into the U.S. Treasury at that point under today's tax rates will only be enough to pay the interest and all that debt, let alone any principal, let alone a single dollar for Social Security, Medicare, Medicaid, or any of the other expenses of the federal government. And so that was one thing that really stuck out. The other thing that really stuck out is they projected out over the next 75 years. And these reports are only allowed to project out over 75 years, but it's always interesting to see what type of sustainability our federal government has over that time frame. In theory, you want to have a sustainable approach to finance over whether it be a 10-year time frame, 20, 30, or even 75. All the smart people in Washington, all the economists say that we should have a debt to GDP ratio, in the mid 60s. Okay, it's predicted that by the end of that 75-year time frame in that Congressional Budget Office report, we're going to have about 575% debt to GDP ratio. Now, that's obviously, we would be bankrupt years before that ever happened. There'd be a Great Depression years before that ever happened. But that just shows you sort of how steep the curve is of unsustainability for our federal government. And you know what's driving all that debt? It's not pork barrel spending. It's not even the military. It's basically three things: Social Security, Medicare, and Medicaid. We have promised way more than we can afford to deliver for those programs. And in order to be able to pay that, we can either dramatically increase tax rates, we can dramatically reduce spending, or some combination of the two. If we do nothing, then that debt to GDP ratio starts to climb at a really dangerous level. And as David Walker, former Comptroller General of the federal government, says, he says that could be the death of our republic.
That's frightening. That's really frightening. So, what? There's some questions I want to cover, and one of them is really when we talked about when tax rates will go up, and I want to talk a little bit about my thoughts about the extension of the tax cuts that you were talking about, the Tax Cuts and Jobs Act, referred to as the Trump tax cuts, and how my own thinking has changed. And Dave was about a year and a half ahead of me. But I always come back to if these things are stacking up and it's getting more obvious. Dave and I were talking at some point, and I believe that the government's going to wait until the last exact moment that they can to act, because there doesn't seem to be the courage in Washington to do anything. And by the way, we don't allow them to have the courage, because if Dave said something, there's got to be changes to Social Security and Medicare. Dave can never, ever, ever run for Congress now because he said that in a recorded session. And if he did, somebody would grab that and say, Dave McKnight wants to eliminate Social Security and Medicare.
Mark, I actually did a podcast a couple of years ago, maybe a year and a half ago, where what I would do if I were president.
Yeah.
And it would be, raise revenue, reduce spending, or some combination of the two. And what would I do? The first thing I would do is I would modify Social Security. I'd push the age out for people like you and me, Mark.
Yeah.
I wouldn't touch it for baby boomers. I push the age out for people like you and me and younger. Modify social or Medicare. So yeah, I'm all over the record as having said, the entitlement program should be modified and modified dramatically. So yeah, I have basically ruled out any political career from here on out.
Yeah, that's for sure. But we as the electorate, we have to allow our we can't just complain about politicians doing nothing. We have to allow them to do nothing. And I'm going to try to stay off the soapbox, but if we just hit somebody all the time about talking about changing Social Security, Medicare, any entitlement program without really listening to the next part of it, because what Dave just said and what most people are saying is we're not going to touch it for the baby boomers, the people that are planned for it and relied on it. But I don't know of anybody in my generation that's really counting on it. And I would certainly accept the first collection age to be, 67 instead of 62. And I'm just spitballing here, the full retirement age to be 72 instead of 67. And maybe if I wait until I'm 75 or 80, I get the most. So there has to be adjustments. And by the way, I'm 100% in support of raising the cap on the income that's counted for Social Security. So these are things that all make sense, but we let the politicians get drive us into fear about losing these benefits. So we as the electorate have to be a little more graceful about allowing our leaders to do something. So I'm going to end that soapbox discussion. But so what do you think? So what I was talking about, Dave, was the extension of Trump tax cuts, or the Tax Cuts and Jobs Act, and that's slated for 2025. And you say it all the time: if Congress does nothing, we revert back to 2017. And a year ago, I heard you saying on the podcast and one-on-one that you thought that no matter who's in office, right, Republicans or Democrats, and you tell me if I'm misrepresenting what you said, you think that those tax cuts will be extended. Now, I don't think Ed agreed with you at that point, right, Ed Slott? And I didn't agree with you, but I have to tell you, I do now, because politically, I see that it's a terrible economic move for us, but it's a good political move for the party that wants to stay in power or take power. So you've won me over on that. There's a lot more people talking about it. So talk about that a little bit if you can.
Yeah, so you can stay in office by sticking it to the 1%. You can stick it to the wealthy and still be elected year in and year out. But you can't stay in office if you alienate the middle class. And even if you let the 22 and 24% tax brackets revert back to the 25 and 28 respectively that they were pre-2018, that would still be perceived as a tax increase. So you did not vote to extend the Trump tax cuts, therefore it's perceived as a tax increase. And neither Democrats or Republicans want to be perceived as having raised taxes on the middle class. And so whoever's in power will likely, if I were a sort of a betting man, which I'm not, but if I were, I'd say they're going to extend the Trump tax cuts. Remember, they're going to do it under budget reconciliation because to make it law, it takes a super majority, but they'll do it under budget reconciliation. Whoever's in power, they just need, and the Senate, you need a simple majority, so 51 votes. So they'll extend it for 8 years, which means if they do it in 2023, that means they'll extend it through 2031. If they do it in 2024, they'll do it through 2032. And we'll all have to deal with the repercussions, the financial repercussions of doing so, because those tax cuts won't be paid for and it'll add to the debt. And which means the fix on the back end, if there is such a fix, is going to be even more draconian, even more aggressive. So I don't think there's anybody at this point who thinks that the middle class is going to have to start paying 25 and 28% tax rates again. But like I said earlier, there's no guarantees in life, but that's just from my vantage point, that's where I see things headed.
So when we get to the point of no return, right? When like we talked about, when the country comes to us and says that there's crisis, and just like during COVID. And if I'm repeating this on this broadcast right now, I apologize. Dave and I were talking about it before, so I just don't remember. But at some point, 2030 around, the government will come to us in crisis mode saying we have to do something. We pushed it all the way as far as we can, and now to save our country, we have to increase these taxes. And there's going to be other increases around. Dave and I were looking at a chart before we started that showed the amount of individual taxes collected by the government. And I'm holding, for those of you just listening, I'm holding up my fingers as wide as I can, and the small amount collected by corporate tax. So even if you doubled corporate tax from 300 plus billion, that would only get us 600 billion. And even if you took it all the way up to $1 trillion, that's still way beyond, or way below, excuse me, what we need in tax increases. So we only bring in about $4.1 trillion in tax receipts. And our costs per year right now, 2022 fiscal year, actually, so not even right now, are about $9.1 trillion. So there's a big gap there. So if taxes if the Tax Cuts and Jobs Act is extended and we come to crisis mode, what do the tax rates look like, Dave, in your opinion?
Is this broadcast rated PG-13? What is this rated?
I think that's YTD, yet to be determined.
I know people say, Dave, your documentary, The Power of Zero, the tax rate is coming, got a PG rating.
I saw that. Yeah,
why is parental guidance suggested? And the reason it got a PG rating is because it has adult themes. We're talking about apocalyptic type tax rates throughout the course of the movie. We're talking about the implications. What would happen to our country if we had to raise tax rates to the levels that would be required to pay for Social Security, Medicare, Medicaid? So it's not pretty. David Walker, I like paying attention to David Walker. He was a former Comptroller General of the federal government. He resigned back in 2008 because he didn't feel like Congress was listening to him. Began crisscrossing the country, sort of trying to raise the warning cry to whoever would listen. And basically what he said back then was that tax rates have to double to keep our country solvent. He even put an actual figure on it. He says by 2030, effective tax rates would have to double across the board. That means that everybody, lowest tax brackets all the way up to the highest tax brackets, would have to double their tax rate. I don't know how sustainable that is, and I don't think he thinks that's sustainable either. But that's if all you did was raise taxes and you didn't cut spending. So the reality is there's going to be some combination of raising revenue and reducing spending. But I think the days of people getting away with a 10 and 12% tax rate, I think those are going to be long gone. I think that the lowest, it's going to go back to sort of what we had back in 1960, where you had the lowest marginal tax bracket was something like 22. The highest marginal tax bracket was something like 88, and that might be for any dollar you made above and beyond, I don't know, $1 million or something like that. But the point is, we are going to turn into I don't know quite how to put this. We're going to have socialist type tax rates. I did a video on this. We're going to have tax rates like they have in Denmark without all the goodies. So you'll have 50% tax rates, but you won't have paid sick leave. You won't have paid maternal leave. You won't have all the goodies that they have in Denmark. You're just going to have to pay 50% tax rates. And all that extra money is just going to go to service the debt or to pay down the debt or to pay for Social Security, Medicare, Medicaid, what have you. So it's fairly apocalyptic, and nobody likes to talk about it. Nobody likes to think about it, but the math is not pretty, and the math doesn't lie.
Yeah, well, I tell you what, I feel very fortunate because I have the opportunity to be involved in Ed Slott's Master Elite Group. There's only 400 of us. There's a few over 400 now in the entire country, and that always amazes me that more people who call themselves financial advisors, planners, or professionals aren't involved in this group, because it's, there's most of us work with baby boomers. There's 70+ million of you, and this is the most important part of your lifetime retirement planning. So I've got a good group of, and I think Ed's group and Dave certainly, but Dave has a group, the POZ or Power of Zero Elite Advisor group as well. And like I said, we were all just down in Miami together. Ed was there, Dave was there, and a group. What was the size of the group you had there? Were there 50?
We had about 75 advisors.
So some of the best thinkers, I think, in the retirement planning space today, certainly the tax efficient retirement planning space, I have the opportunity to spend time with and discuss with this. And my feeling is, and even some of the others I talk to, is that your average middle class American is going to be in the 40 to 45% effective tax rate when these changes go through. Because Dave mentioned the 20, I think you said the 22% rate or the 25% rate and the 88% rate, but he didn't mention the middle at about 63, right? Is it, if I'm remembering what the Congressional Budget Office projected, right? Some time ago. And that's where most of us live, right? In that middle. Most of the country lives in that middle. So you can see when you kind of pan back and look at the projected rates, even if it's just 3 or any iteration of that, they can make it 5, but it still has to fall on those numbers. Most of us are going to be in the 40 to 45% effective tax rate if you don't.
And you're referring to that Congressional Budget Office study where they basically said, I believe the 15 becomes the 25. The 25 is this back when there was a 25. I think 25 becomes a 63, and then the 35 becomes the 88, something to that effect. You average together, the effective rate, if you're paying a portion at 22 and a portion at 63, you're going to be in the mid 40s, something like that. I think that's what we're looking at. And this is not to try to wax apocalyptic or to be sensational or inflammatory. This is just what the cold hard facts are telling us. And frankly, Mark, every year that goes by where they fail to address Social Security, Medicare, Medicaid, and the burgeoning debt means that reality is all the more unavoidable, unfortunately.
Yeah, and we're being told. So, the Treasury report that came out a week and a half ago from the U.S. Treasury, the term was an unsustainable fiscal or financial situation that the country's in. And this isn't the first time that's been said. It's been said over and over, and going back at least, 3, 4, or 5 years. So it's almost like that Surgeon General warning that I assume is still on a pack of cigarettes. I don't smoke. But the Surgeon General stamps on there that basically, if you continue to use this product, you're going to have horrible things happen to you, and people still do it. And we are constantly told, because anybody can go on and retrieve these documents. It's not secret for anybody in financial industry. You can, we've got this thing, Google. Anybody right now, Google U.S. Treasury report or Congressional Budget Office report and pull down. The U.S. Treasury report is only. And maybe I haven't reversed, but the executive summaries are only at most 10 pages. So it's worth reading if you have an interest in the future of your retirement at all. But it's certainly we're headed in that direction. Now, you talked about David Walker, and we talk about David Walker a lot, and he's a great resource. But what are some of the other experts out there saying? Because I know you really keep your
I did another video on 8 experts that have predicted that tax rates are going up. These are all people that we've heard of before, and I have to I'm going from memory here. So you had Leon Cooperman, who is a hedge fund manager. You have obviously Ed Slott. You have Ray Dalio. You have I can't remember. I had 8 of them in there, and they're basically all pointing to the same signs, which are Social Security, Medicare, Medicaid. They're on this unsustainable trend. And if we do nothing, it will necessitate a dramatic rise in tax rates. So it's not like there's just these few lone voices in the wilderness that are crying out, take advantage of low tax rates. It's getting to the point where you can't really find anybody anymore who doubts the tax rates down the road. And I love to share this story. I apologize if I've shared it on your podcast before, but there's this guru out there who calls himself the White Coat Investor, and he and I got into it. He wrote a scathing review of The Power of Zero right after it came out. He said, does it make sense to be in a 0% tax bracket? No, because tax rates in the future are not going to go up. Tax rates over time have ebbed and flowed. They're low now. They may be higher later, but they're going to go down again. And I basically said, look, that's an outdated paradigm. Tax rates go up when it's wartime, they come down in the post-war period. And that has been sort of the history of tax rates. Well, we're marching into a future where that paradigm is going to get discarded. And so he and I sort of argued back and forth on over the series of 4 or 5 blog posts. And he basically said, look, I think we're just going to print our way out of it. And I said, look, you can't print your way out of it because Social Security, Medicare, Medicaid are all indexed for inflation. If you print your way out of it, inflation is going to go up, and the cost of those 3 programs is going to rise commensurately. So you can't do that. So we sort of left it at that. And then Joe Biden was running for president. I think this was, what was it, 2019? And he basically came out with this tax plan. And I read a tweet by the White Coat Investor in which he said, wow, Joe Biden's tax plan reads like an all-out war on the individual investor. If Joe Biden gets elected, I am going to do a Roth conversion on all of my IRA retirement savings. I'm going to do it all in 1 year. And so let's put aside this whole notion that it's bad financial planning to convert your entire IRA in 1 year. But he was basically conceding that whether it's Joe Biden or somebody else, the specter of higher tax rates means that you should be thinking about things like Roth conversions. And so even the naysayers, Mark, like the White Coat Investor, are starting to come over into our camp, that it makes sense to do things like Roth conversions. He and I argued for 5 blog posts on why he thought a Roth conversion was not a good idea, and I thought it was. And now he's saying not only is it a good idea, but I might convert my entire IRA all in 1 year, which you and I both know you're supposed to stretch that tax obligation out over a lot of different years, not do it all in 1 year. So like he was giving himself bad advice. So so very, very few people are now questioning this idea that tax rates are going to go higher and higher in a precipitous way.
Yeah, one of my favorite stories is I have a client whose accountant battled me about Roth conversions, and I shared your book with him, The Power of Zero. And the following year, I had to pull him back from over converting because we said, I basically went with a recommended in the plan, whatever it was. Let's just say it's $85,000, and he came back in an email. Well, why don't we do $150,000? And I said, well, all right, cool your jets. I appreciate the fact that you did a complete 180, but let's keep him in the 24% bracket instead of skying out his. My 24 is my favorite tax bracket. 32 is my least favorite tax bracket because if you're bumping up into the 32, it's an 8% increase. And you're much better off stretching that tax obligation out, staying in the 24 over time. So that's funny that he wanted to go up into the 32. It's something I almost universally recommend against. I know you do. And we've talked about that before. And the good news is that I feel some relief, and I hope you're right. And I hope I'm right now, because I'm taking co-ownership of this prediction that the Tax Cuts and Jobs Act are going to be extended, with the caveat that we never know what Congress is going to do. But it gives us some grace and some comfort and not really having to rush to the end of 2025. Obviously, if we're able to get conversions done comfortably by the end of 2025, or tax efficient transfers done by the end of 2025, it gives us some relief from that tax rate risk. But I think that we can probably ease on that a little bit, and that's the advice that we're giving our clients. And I do have, it's funny because I've been explaining this to some class attendees that many people get concerned in the beginning. You make a recommendation of $100,000 conversion, and they say, well, can we do 50? Because I've got to ease into this. And then often the second and third year, you're backing them off the gas saying, well, wait a minute. Okay, let's go up to back up to the 100 or whatever it is needs to be at the time, and not do 300. Right, or not try to do it all. So it's an interesting progression, and I'll just remind people that if you're planning on your own or planning with someone who's not specifically trained in this, you've got to review these plans every single year. Because if Emily Wheeler was sitting here with us, who's our senior financial planning associate, if I asked her how many plans we have where the Roth conversions are the same every year, she would likely say none. Right? You've got to look at it. There's always reasons to make changes, it seems. All right, so we talked about the experts. We talked about what we think rates will go up to. We talked about when tax rates will go up. now let's shift a little bit and talk about investments. What are your thoughts about investments and what we should be doing today with investments?
You're talking about in terms of like portfolio makeup, stock bond mix, or you're talking about?
Let's stick with tax efficiency around investments.
Gotcha. Okay.
Mhm.
Yeah, I think that you should have a diversified stream of tax-free income. I think you should take advantage of every nook and cranny in the IRS tax code. I think that, as you know, Mark, we typically recommend 6 different streams of tax-free income. We talk about the Roth IRA, the Roth 401k. We talk about the Roth conversion. We talk about being able to take money out of your IRA and have that distribution offset by your standard deduction, which makes that IRA distribution 100% tax-free. We talk about the LIRP, or the Life Insurance Retirement Plan, which is great because it gives you a death benefit that you can spend in advance of your death for the purpose of paying for long-term care, and the cash value is growing in a tax-free way, in a safe and productive way. And we also talk about how if you keep your provisional income low enough, then your Social Security can also be tax-free. And by the way, if you have 6 streams of tax-free income, none of which show up on the IRS's radar, what tax bracket does that put you in? It puts you in the 0% tax bracket. And the reason why I advocate for 6 different streams of tax-free income is, number one, if the IRS ever legislates one of those streams of income out of existence, you've got 5 others to buoy you up. But not only that, but each of those streams of tax-free income does something different, does something in a unique way that the other streams of tax-free income doesn't do. So for example, why do I love the Roth 401k? Well, it does something that none of those other 5 do. Namely, it gives you free money. It's a company match. You know, a Roth conversion can't give you a company match. A Roth IRA can't give you a company match. Why do I like a Roth IRA over a Roth 401k? Because you can get liquidity on your money. You put the money in, you could take it right back out. You can't do that in any of the other investments. Why do I like the RMD offset by your standard deduction? Because you get a tax deduction on the front end, it grows tax deferred, you take it out tax-free. There's nothing else like it out there except for maybe an HSA. So the idea, and then of course we talked about the LIRP as a death benefit component that you can spend for long-term care. And if you die peaceful in your sleep 30 years from now, never having to need long-term care, someone's still getting a death benefit, probably your kids or your grandkids. So you've got these 6 streams of tax-free income that you can utilize. We're talking about taking advantage of everything that the IRS is offering you. And the reason why they offer these different things is because they have different attributes that make them unique. You should be drawing upon all of those unique qualities in your financial plan, with the idea that you ultimately land in the 0% tax bracket. And you and I talk about why the 0% tax bracket is so important, because if tax rates double, like David Walker and others are predicting, then 2 times 0 is still 0.
Okay, folks, that was the end of part 1 of my interview with Elite Power Zero advisor Mark Bialik. If you want to learn more about how to shield your retirement savings from dramatically higher taxes, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power of Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.